All right. So before I get to Tarun's doubt, let me just clarify one thing. So Saruni was asking about these courses and stuff, right? And I've also sent you a list of MOOC portals and stuff like that before. Okay. So I don't want to get you guys distracted. The thing that should be understood very clearly is that all this extra stuff that we are giving you, okay, extra stuff that you can do, that it's assumed that it is after you do justice to your curriculum. Okay, and especially since you guys have chosen finance, now you will be known as MBA finance students. So at least you make sure that you do justice to your MBA finance curriculum. Okay, so all the stuff that so whatever else, before you take on some extra stuff outside, okay, I would suggest you make sure that you understand your FM1 and FM2 syllabus very well. Okay, and out of that I would initially point you to financial statement analysis, which you would have done, I think, maybe at least not in FM1 and FM2 accounting. So when I say FM1 and FM2, it includes the accounting courses also. So all your finance and accounting, so you can't be weak in accounting. If you're an MBA finance student, you can't be weak in accounting. Okay, so two things that I would tell you straight away. First is double entry bookkeeping. Everybody had better understand how to do double entry bookkeeping, that is to pass journal entries for any imagined transaction in the world. Okay, if I tell you any transaction, you should be able to just like that do double, tell me what the journal entries are. Make up some names of accounts, but it has to obviously make sense, right? You can't write accounts payable for accounts receivable. So, but make up some, names of accounts, but you should be able to show that you have understood the transaction. This is a very good test. It's an asset test for understanding any transaction. If you can pass the right journal entries for the transaction, that means you have understood the transaction. That's one important test. So, whether you're from a commerce background or not, you better make sure that before you graduate, okay, you are very fluent in these journal entries and this concept of double entry bookkeeping. This is one of the essential requirements of a finance student. It should be totally fluid for you. If you have any doubts, you can go and ask Ratan sir, you can come to me or whatever. Okay, practice it. Okay, so make sure this is your responsibility. Once again, you'll notice a lot of the stuff that you have to do in this program towards becoming a better finance student. A lot of the stuff has to be done by you. Okay, I can't sit here and spoon feed you stuff. Okay, so I'm like your coach. As I told you, I will tell you that, okay, your forehand is weak, you better go and work on your forehand, and you got to do it on your own. Okay, so this is how it has to go. So I'm telling you, this is something you need to work on. You make sure that it happens. Okay, and as I said, if you have any doubts, you come to me, you come to Ratan sir or anybody else. Okay, journal entries, 100% clarity, and there's no such thing as I've understood a little bit and all that. Either you are totally confident and fluent, or you're not. Okay, so that's one. Number two, financial statement analysis. At this point of time, as far as your FM1 and 2 syllabus is concerned, I would only direct you to these two parts. Later on, if I think some other parts are more relevant, are also relevant, then I'll direct you there. Financial statement analysis, let me write this stuff down here. Okay. Journal entries for any transaction. Okay, you understand what I mean by this, right? Now we've already had the discussion. So for this we write journal entries for any transaction plus fin statement analysis. Is it okay if I write these short forms?
Yes, sir.
Yes, sir.
Financial statement analysis. Balance sheet, P&L, you can access all the material, whether you go to Money Control or Reuters or Yahoo Finance, you can access all the material. Be familiar with balance sheet and P&L for you guys should be like WhatsApp. Okay, so, and you should be able to do any kind, so, and then revise your ratios. Financial statement analysis, then including cash flow statement, okay, cash flow statement, fund flow statement, I mean, then statement of, in the US they have a concept of statement of changes in shareholders' equity. Okay, that also you should master. It's not a big deal, it's the same concept. Once your balance sheet and P&L concepts are clear, you should be able to see changes in shareholders' equity, how it's happening. Okay, so financial statement analysis including cash flow statement, etc. So when I say etc. means all the other statements are also included. Okay, so all this stuff you should be able to do. Again, what will happen is this will also get, and this will also help you when DG Sir does a course. Last year we did it in the last semester, so maybe this year also we'll have it in the same way. The last semester he'll do a course called Corporate Financial Modeling, which is essentially a mix of your financial statement analysis skills and Excel. Okay, the ability to program in Excel. Understand that, well, again, I've used Excel, actually I should say spreadsheets, okay, because you can do the whole course without Excel. You can do it in Google Sheets, okay, you can do it in Zoho Sheets. There are all kinds of sheets available online. You can do it in Microsoft Online Drive, Microsoft Online Program, Online 365 or whatever it is. Okay, so it's a combination. So if you do this, it will also help you there. Okay, once again, make sure that all this stuff you have to take it to the level, you keep on practicing. Okay, everything, you have to have this habit of practicing, because I have a feeling that most of you guys are not doing this for any subject. You have to practice it until you can just do it in your sleep. Okay, and until you get there, for some people it may require 5 sessions, some people it might require 11 sessions. That is, you adapt it to your individual needs, but you have to practice it till you can do it in your sleep. And you know, you can't fool yourself. You know when you've got there or not, whether you've got there or not. So you practice it till you can do it in your sleep. Okay, so this includes cash flow statements plus ratio analysis. Okay, you've done DuPont ratio analysis.
Yes.
Okay, so all this stuff that you've done, DG Sir's book will have a lot of material on this. Okay, if I've given you some, I've given you the, I'll try and find some other material if you have. I'll show you something else on ratio analysis. You should add, so for ratio analysis, make sure you do a taxonomy of the ratios. Okay, that is a classification of the ratios. Okay, so don't try to remember just ratios, all, because there are so many ratios you will get a little confused. So whenever you're required to discuss financial ratios, okay, you should always call categories into your mind. So that is, you have activity ratios, okay, profitability ratios, and then you should say under profitability ratios I have A, B, C, D, E. Okay, under activity ratios I have A, B, C, D, E, etc. Okay, so therefore what I would say is, so this is what you should do. So to create a taxonomy, and then ratio analysis plus including taxonomy. Okay, and here let me, so the word taxonomy, which you will encounter again, so you're learning a new word. Okay, so taxonomy means two things. It can be used in two senses. Okay, one is that it's a classification system. Okay, a taxonomy is a classification system. In your biology classes in school, you might remember all this genus, species, mammals, etc. Right? So all these things, so we are from the genus is mammals, if I remember right, and species is Homo sapiens. We are from the species Homo sapiens, but there are other mammals also, as you know, right? So this system is called a taxonomy. Okay, I mean the whole science of classification is referred to as taxonomy, but a particular classification can also be referred to as a taxonomy. That is also a proper use of so. So if I take all the WIP students and classify them into BBA students, LLM students, okay, then MCA students, BCA students, and say that okay, these are the categories of WIP students, then that's also a taxonomy. So that I would refer to as a taxonomy of WIP students. Okay, is this clear? So it can be used in two ways. It's a science of classification, okay, and the methods and principles that are included in that, or it could also refer to a particular classification. In both cases, you use the word taxonomy. Is this clear? So you've learned a big word, okay? So if you want to impress people, you can just say taxonomy. Okay, I'll show you, we learn some other big words as well. So ratio analysis including taxonomy, and on this point, what we want to add, there's one category of ratios that may not be there in a typical finance textbook, because most of the ratios that are discussed are based completely on the balance sheet and the P&L. Okay, completely on the financial statements. Okay, but there is one category of ratios which is not really based on completely on the financial statements. Okay, which is basically this. So let me just show you here. If we go to FinViz, This also you can play around with. This has some pretty good software. Even the free versions have some pretty good software. Okay, so here if you go it's taking a long time to load. Okay, if we look for Intel here, okay, the ticker for Intel is INTC. If I go for Intel, okay, then okay, I get this. Okay, so here I would go here and look for let's look for highlights. Okay, now you notice that it takes you to this Reuters page. Okay, so I would actually put this here. This is the link that you should have, because if you try to go to Reuters directly, Reuters.com from India, it will keep bouncing you back to the India website, where we'll have some problems. Okay, so ratio analysis including taxonomy. Here I'm putting in a ticker, and you'll see why. Because if you see here now, this is the financials for Intel. It's just sending you to Reuters. Okay, now let's look at so you can look at all this stuff, some of the stuff that people look at here. So you have these valuation ratios. Okay, these are again really not part of, strictly speaking, financial statement analysis, but it does include some information from the financial statements. So you should add the valuation ratios also, okay, into this as part of your, I mean, put it in there, because we can discuss it in valuation as well, but we can just put this in here. So what I'm trying to say is, because you notice something about the valuation ratio. Okay, so some examples of valuation ratios are, what is this? What does PE stand for? Price to earnings. Okay, so out of this, which out of, in this ratio, which one comes out of the financial statements? Earnings, right? Okay, and even then, if you notice, there is this TTM part. What does TTM stand for? So TTM stands for trailing 12 months. Okay, so trailing 12 months means we don't go by the complete, we don't go by the discrete financial years. So when I'm in March, it will be the last 12 months. When I'm in June, once again, it will be the last 12 months. So it's like a moving average kind of thing. It keeps on shifting. Okay, so trailing, basically any point of time, the last 12 months. Okay, so this, when I asked you this question, which of these comes from the financial statements? Okay, the answer is earnings, but actually the answer should have been even more specific, because it's only the TTM, it's only in the case of the TTM PE ratio that the earnings figure comes out of the financial statements. Okay, there is also something called, here they haven't given the other PE. Okay, they've only clarified this, but let me just clarify, since we are discussing this at this point. Okay, PE ratio, which is very important. Okay, it should be TTM. It can either be TTM, or it will be what is called forward PE. Okay, so it's either PE ratio TTM, or it's a forward PE ratio. So this should be like this. Okay, all right. So are you able to follow why I made this statement? So you have to understand there are two types of PE ratios. Okay, one is the trailing 12 months, so it'll write TTM in brackets like this. Okay, you'll find this on Yahoo Finance as well. So that in that case, the denominator comes straight out of the financial statements, because they take the earnings of the last 12 months, the actual earnings as reported. Okay, the actual earnings as reported for the last 12 months are taken as the earnings figure for the year. Okay, and then you have the price which is coming from the market. Okay, so that's the TTM PE ratio. Is everyone clear about that? Price per share divided by earnings per share. Okay, so you take the earnings per share from the from the financial statements. Okay, and you take the trailing 12 months data, and you have the 1 year earnings per share. Okay, and then you have the price of the market price. Okay, that's one. Then there is the forward PE ratio. The forward PE ratio is So all this stuff is in your notes, obviously. You have this file in your folder, okay? So you don't need to write this. Just make sure you understand it, okay? Consensus earnings estimates from equity analysts, okay? Okay, so from equity analysts, okay? This is, you can have basically, usually 1 year forward, okay? When you see a forward PE ratio, you have to see exactly how it is. Usually, it will be a 1 year forward PE, next year's earnings projection. Okay, so this obviously, do you think here this denominator, does it come out of the financial statements? This earnings figure in the forward PE ratio, is it coming out of the financial statements? At least directly, it's not. It is coming out of the earnings estimates given by analysts. Okay, so different analysts. So here they will take the median estimate is taken. Okay, the median estimate of analysts is taken as projected forward. In this case, it's not forward PE, it's forward earnings, and then you just apply the market price. So if you go, in fact, on Yahoo Finance, you'll see that in here the Reuters page is showing you only the TTM PE. I think on Yahoo Finance, if you go there and see the comparable display, they'll show you both. They'll show you the forward PE as well as the TTM PE. Okay, the trailing. So this TTM is usually sometimes called the trailing price earnings ratio, and this is the forward price earnings ratio. Okay, so when you see people discussing on business television, you will see now who has opened this. Chug has opened it. No need for you to open it because you can see it on the screen. Okay, so so this is so you take you get a whole bunch of equity analysts who are forecasting 1 year forward earnings per share for Intel. Okay, and then you take that 1 year forward, you take the median forecast. Okay, there'll be a bunch of forecasts, you take the median forecast. Now let me just test, because I found out with your seniors that nobody knew what median was. Your immediate senior batch in the second year when they were doing it, and I discovered this quite late because the occasion didn't arise until FDRM or something, which is the third, the final earnings, the final elective course. Yes, Sukriti, can you tell me what is median? Give her the mic. Give her the mic. Let's you make use of the mic. Does it work? Don't ask her. Don't ask her. You tell me. Sorry. Come again. Be quiet. I can't hear her. Something in the middle. What is something in the middle? No. Be specific. You have to answer. You're a finance student now. You can't say something in the middle. Give me a specific answer. So if I have if I have 11 observations, okay, arranged from say low to high, okay, what is going to be my median?
So fifth and sixth observation. We can say the sixth observation is our median.
Okay. Okay.
Because 5 observations before 6 and
okay, good. So at least you have understood median. Yeah. What happened? Okay. So only one person goes out at a time. You're the gatekeeper. Okay. All right. So yeah. So she has understood. So the median is the one which is the middlemost value, right? Okay. So the one where half the things are above and half the observations are below, right? Yeah.
Back to which term is
yes, sir.
Sorry.
And
back to which observation is
yeah, and of course you have to interpolate if you have like an even number. Okay, if you have an even number of observations, then you'll have to interpolate and find the median. Okay, at least good, very good. Then at least you guys are much better than your senior batch as far as the retention and median is concerned. Okay, good. So in general, remember in financial markets, whenever we look at in financial markets, whenever we look at the estimated figure, okay, like if you might listen to GDP data is coming out, okay, and they look at what was expected. One of the things they would look at is what was expected. So let me actually, since we are having this discussion, let me put this also. Global. Yeah, it's actually there. Okay, it's not there. Okay, so here this is the web page on which you can get. This is another important thing that you guys should look at, just keep track of, which is this is the economic calendar. Okay, this is the economic calendar, the global economic calendar, on which it's taking a long time. Anyway, it doesn't matter. So in financial markets in general, whenever people are talking about some kind of estimate, analyst estimate, what are people expecting? Okay, what are people expecting? Anywhere where you're going to take input from a whole bunch of analysts or economists and try to come up with some kind of a measure of central tendency, okay, to give one number as an expected number. What is the market expecting? Okay, when you listen to US non-farm payrolls releases, you'll see that the market was expecting 165,000 and the data came out as 195,000. Okay, so it was better than expected. Okay, so when you hear how did you arrive at the expected number? The expected number is generally taken as the median of the economists who have been surveyed. Okay, the median forecast. That is what is the expected number. So it's important to understand that. So if you see here, actually there should be a global. Anyway, never mind. I'll just put this here in your. Okay, let's just put it here. Median estimates of analysts. So, okay, this is another useful website. I can't see the calendar here, but I'll put the calendar in later. Okay, all right. So is this clear so far? Are you guys following?
Yes, sir.
Yes, sir.
Okay. So the theme that we have been developing is that all the additional material that has been given to you all through the MOOC courses and whatever stuff that Saloni is looking at, other stuff. Okay, that can be done only when you feel confident that you have mastered everything that has been taught to you in the curriculum. And especially since for finance students, I've already told you, go back and master journal entries and master your financial statement analysis, ratio analysis, all this stuff. Okay, do multiple exercises. It will help you in your last corporate financial modeling course as well. And I think essentially after this you don't really need to do anything outside, because I'm finding that a lot of your seniors also are not, batch after batch, we are finding students who are not able to master the entire curriculum. Okay, so your first goal should be to master, and master means once you've understood the concept thoroughly, you'll never forget it in your life, or at least not for the next 10-15 years. Okay, so that's how well you have to master it. So I would suggest that you don't have to, at this point of time, you don't need to worry about all the other stuff that is floating around outside. Okay, so if we feel that you really need to do something, I'll let you know, and then you'll have a lot of other workload that has been given to you outside the curriculum, tracking those stocks, 5 or 6 stocks which I've asked you to track. That is very important activity. Okay, so right, so don't get swayed by, I think to some extent I see this problem, that was quite significant in your senior batch, that people get obsessed with gathering certificates. Okay, I think there's a tendency to try and gather certificates, and I want to gather certificates and put it on my CV. Don't be stupid, because the people who come to interview you are not stupid people, so they'll be able to sense it immediately if your concepts are not clear. You can't fool people by gathering certificates if your concepts are not clear. If your concepts are clear, then it's fine. Okay, but you make sure that your finance concepts are absolutely clear, and especially financial statement analysis is very important skill, and it's a really useful skill, I would say, compared to all your Markowitz portfolio construction, all this efficient frontier and stuff. Really not much use in the real world. Okay, it's very theoretical, but financial statement analysis, if you can master, it is a very useful skill. Okay, in the real world, because that's pretty much what you'll be doing, a big chunk of what you'll be doing as an equity analyst or a credit analyst. Okay, so it's very good to have a grasp of financial statements and ratio analysis. Okay, right, so that's the first lesson. Don't get distracted, don't get don't get seduced by this certificate gathering thing. Okay, forget about all that. Focus on your curriculum, focus on knowledge, and focus on mastery of concepts. Okay, everybody understands by now what a concept is.
Yes, sir.
Right, so all the stuff, if you go back to the example of your law course, like if I ask you now what is an ultra vires transaction in corporate law, you'll be able to tell me.
Yes, sir.
So the concept here is that you'll be able to take the objects clause from the memorandum, okay, and that objects clause defines the company's capacity to contract, okay, and so through the activities that are listed in the objects clause. And so if the company engages in any transaction which is not covered by the activities in the objects clause, that's an ultra-virus transaction because it's beyond the powers of the company. So the specific pillar on which that contract would, the agreement would fail would be that the company doesn't have the capacity to engage in that contract, enter into that contract, okay. So this is what I mean by a concept. So if your concept is clear, you'll answer like this. And then once you have understood it this way, you'll never forget it. Is this clear? So whenever you see all the material that has been taught to you, you should be able to detect now where there's a concept involved. And then make sure you understand that concept thoroughly. Is that clear? Okay. So that's the first lesson. Extra courses and need to revise. So no, basically lots of need to revise and no extra courses. Okay, that's the no extra courses, lots of need to revise. Okay, that takes care of all this stuff. Okay, yeah. Anything? Any question? Okay, we are coming to Chug has a bunch of questions, and this is bringing us to the next point. Okay, it's bringing us to the next point, which is alertness in class. Okay, let's just take it from here. Okay, so the other problem that I'm finding is, now who can help us with, let's say Chauhan, can you tell us what is, Chug has these questions, bearish, bullish, long and short. Do you know what bearish is?
Yes.
Yeah, give him the mic, tell us what bearish is. So tell me here, if I'm looking at this chart here, so here's my dollar yen chart. I actually have a position in this, but let's see. So if I tell you that I'm bearish on dollar yen, so what does Chauhan make of it? What does that mean? What is my view? Is it working?
Hello?
Yeah, it's working.
Yeah. When the stock is low,
Don't talk in terms of stock.
Okay.
Talk in general terms. Okay, talk in terms of a market, because here I'm talking about dollar yen, which is, we're talking about currency markets. There's no stock involved here. So if I tell you that my view on dollar yen is bearish, okay, what does that mean? What do you understand about what my projection for this market is?
so
Is my question clear?
Yeah. The market is actually not doing well.
Can you be a little bit? Can you be more specific? I'm telling you that my view on dollar yen is bearish. So, what do you, from hearing this statement, what do you understand about what kind of mental projection I'm making about this market? Remember, I told you you have to make mental projections.
Yes, sir.
Yeah. Okay, so we'll save some time. I'm sure Tarun knows the answer, but we'll save some time. Essentially, what this means is that my mental projection for this market is that it's going down. Okay, this is what it means. It's going down. Okay, so this is what is meaning of bearish. Okay, so the general point I want to make before I explain these specific terms is so John was close that you feel that it's not very good. You need to be more specific. Okay, essentially that you can be very specific and say that I expect this to go down. This particular thing, I would expect this to keep going down here and making new lows. Okay, and to be more specific, actually, if you point out the actual highs, then I don't expect it to be going above this. Okay, but essentially what this means in broad terms, bearish means that I expect this market to go down. Okay, now coming to this, the more general point, alertness and class. So this, I mean, Chug was telling me that Indira ma'am has also used these terms bearish and short many times. But then my point is, why have you not, if you hear terms that you don't understand, okay, this is what I mean by being alert and what I call listening aggressively. Okay, listening aggressively means you're very alert, and as soon as you encounter any word that you don't understand, you should immediately ask a question. Okay, have I forbidden you from asking questions?
No, sir.
So then why, my point is that and I'm sure if I ask everybody, not everybody would have been able to give a good definition of bearish. So that means many other people did not understand this term, but nobody bothered to ask. So another thing you need to change. If you want to be a serious finance student, you have to be, because the material that is covered is vast, okay? And almost every day, if you go back to the video lectures, almost every day, I'm pretty much continuously throwing new concepts at you, okay? So if you better understand everything, otherwise I will not move to the next concept until everybody has understood the first concept. That's how we should operate. Okay, I'm not concerned with, luckily we have the flexibility here. We don't have to do this stupid syllabus chasing, which I think is not a very intelligent way to teach. So because then you have a pressure, you don't have quality. Okay, so what we want to ensure, but at the same time what we want to ensure, and your role is very crucial in this, is that we must ensure that whatever we have covered, okay, I'm sitting here shouting, I have a tendency to shout anyway, so I'm sitting here shouting all the time, okay, so, and you guys are wasting your time, sitting in the class and listening to me. So let's make sure that this whole exercise and this expenditure of time and energy on our part is fruitful. Okay, and fruitful means that everybody, whoever hasn't understood a particular concept, should immediately ask a question. Okay, so that we can clarify that concept. Okay, this is how you learn, because unless you ask questions, you'll find it's very difficult to learn. Like I was watching a MIT course on statistics, and at a point when he explained a few terms, I had a question, because just to make sure that I've understood it correctly. Okay, but obviously I couldn't ask the question because I'm looking at it on YouTube, right? So this is why you need to be in class, because in order to internalize something perfectly in your head, okay, to understand the concept perfectly, you need to understand it in your own particular way, and then you also need to make sure that you have understood it correctly. Okay, so that's why it's important to ask questions in the class. So make sure you do this. Don't make this mistake. Anytime you encounter any term which you don't understand, immediately you have to ask me. Okay, so that we can clarify this. Okay, so now bearish is clear. Okay, so bearish is, yeah, one sec. Oh, you also had a question, I forgot to come to that. Okay, one sec. So let me first explain bearish and bullish. Okay, so obviously I'm not going to go around asking too many people, because we want to save a little time as well. Okay, I hope you guys are not finding this format boring, because obviously it's done. I could also go around and ask 15 people, but then obviously we are losing that much time. Okay, so you have to, as I told you, you have to understand this. I'm not here to make finance interesting to you. These are the concepts that you need to understand if you want to be a finance student, and it is your responsibility to master the concepts. I am here to explain the concepts to you and to design the syllabus. Is everyone okay with this?
Yes, sir.
This deal is okay?
Yes, sir.
Vital, you have signed up for this, you're okay? Okay, good. So bearish and bullish, let me just explain. Okay, these are applied, okay, let's have it in blocks so it's easier for me to see. Applied to views, okay, on markets. We'll explain what markets are. We haven't even got to markets. Applied to views on markets. So here let me just, so view is like essentially a mental projection. Okay, so for instance, my view on dollar yen is bearish, and specifically what that means is, my view was, that's why I went short over here, my view was that this downtrend is still continuing. Okay, so this will go this way, it will go further lower than this, below 106, below this, and eventually even break this, and it will not go above this. Remember I told you that whenever you form views, you also have to decide, you have to also identify a point on the chart, okay, at which or beyond which your view is wrong. Okay, so this is my basic view. My basic view is that this downtrend is continuing, so this will actually go down from here and break below this, eventually break below this as well. And what is the pain point, or the point at which my view is invalidated? It is this high. If the market goes higher than this, okay, then my view, I've decided that I will surrender I will give up my view. Okay, so this is how the view is formed. So this is a bearish view, and this essentially is the stop for the bearish view. This is clear? This is what we loosely call a stop loss, but when you come to study orders, you'll see that systems don't accept any stop loss orders. What they accept are stop orders. The technical term is stop orders, but it's useful to think of it initially as a stop loss. It gives you a little context. Okay, this is clear so far? This is the meaning of a bearish view. Yeah, okay, yes.
US dollar to Japanese yen means how many US dollars we get in for one.
Okay, I'm coming to that. That will get answered a little later. Okay, so we'll just come to that. We have to understand markets as well, because we haven't even understood markets. So there is a technical definition of markets as well, which you will learn. But the idea first is that bearish and bullish are applied to views on markets, and a view is like a mental projection. Okay, that you have to make a mental, because otherwise you can't trade. You can't do anything, not just trade, but even to manage risk for a corporation. If you're a CFO looking at an equity issue, okay, you will have to take a view on the market. Because if you think the market is going up a lot, okay, immediately, then you will not raise capital right now. You'll wait, let the market rise for a while, and then at much higher levels you'll try to sell your equity. But if you feel the market is going straight down immediately, then you'll hurriedly try to sell your equity so that you capture the high levels of the market. Are you following? So it's not just about trading. It's also about managing risk for a corporation. Everywhere you go in finance, you'll have to take a view on markets, pretty much everywhere. Okay, that's why these courses are heavily centered on financial markets, and that's why you have these three project-driven, software-based projects, which give you a feel for actual market prices and how they move. Okay, this is clear? Okay, so this is bearish and bullish are views that are adjectives used to describe views on markets, and a view is a mental projection. Okay, so if that is the case, then the bullish view is, obviously, if my view is bullish, then is going up, right? So if my view is bullish, then the market is going up. Okay, so applied to views on markets. Okay, so here I think it's already written down in your notes. I've explained it in your notes. Okay, I'm just going to write up here. Sorry, this should be down. It's already there in your notes, and when you look at the actual flow of your notes, which is here in this unit 1, when you look at that unit 1, it's there in your notes. We can find it in your notes, but anyway, I'm just writing it here. I'm just writing bearish implies down and bullish implies up. Is this clear? All right. Okay, and it's sometimes people use it to describe history. So it's usually because a view is a mental projection about the future. So the classical use of these terms and the proper use of these terms is with respect to future movement. What will happen? Okay, that is the right way to describe it. Sometimes people might do sometimes people might say is that if they look at just this part, let's say, if they've just been looking at this part, they might also say that the dollar yen has been in a bearish trend recently. That means they're using it to describe past activity. Okay, so are you following? Sometimes people might say that because it's been going down, so they might say that, but that's not a very good use of the term. The proper use of the term is to use it to refer to views which essentially are focused on the future. Okay, views are on the future, and views relate to the future, so therefore it's used to, the classical use of bearish and bullish is for to describe views on the future of market activity, or the directional move in the market. Okay, so bullish, bearish, and long and short, again, some of this stuff will become a little clearer when you we will do it once again. So here, long and short, I'd rather do this later, but essentially let's just I'll just write this way. Okay, we'll do more technical definitions a little later. So long means essentially here, like as I told you, my view was bearish. Okay, so I went short dollar yen at this point. Okay, I went short over here and my stop is over here, so we'll have to see if my stop is triggered. Okay, so at this point it's still okay, so I've gone short here. So bearish and short go together, and bullish and long go together. Okay, so when you have a bearish view, ideally what you should do is you should go short. Okay, sometimes people have a view but they don't do anything, but if you do something on the back of your view, you would be going, in the case of a bearish view, you would be going short. Okay, and in the case of a bullish view, you will be going long. Okay, so we'll come with we'll give you more technical definitions of this a little bit later when we cover the necessary material. Okay, so we still have to come to Tarun's question. So we have covered bearish, bullish, long, and short. Yes, Juk, you're satisfied so far with the limited definitions, right? Bearish, bullish, long, and short. Okay, now coming back to Tarun's question. You had a question earlier. Use the mic.
Sir, as per my view, bearish and bullish until my...
Okay, one more thing. As per
ask.
Just be aware. In India, you'll have a problem because if you just say per, people will say you're using wrong English. But actually, as per is superfluous. Okay. So, because per is a Latin word which means according to. So if you say as per, you are saying as according to, which is not correct. But in India, you'll find even Supreme Court judgments they're writing as per. So, but if you look at any document written by Australians or Britishers or Americans, you will not find as per. You will see that it's per. Okay. So the correct usage is per. But as I said, of course, in India, if you say per, people will say you're using wrong English. But anyway, so you should be aware of this. Okay. All right. Go ahead.
Sir, according to me, bearish and
Good, very good. He's applying his learning straight away. Yes.
bearish and bullish until now, whatever knowledge I had, it meant to be like bearish, meant to be a slow moving quantum when quantum of moving of market was very slow. Like it does, the price of something doesn't change as much, then it is known.
Doesn't change much.
Yeah.
Doesn't.
So
Okay, no, that's not a correct understanding of bearish and bullish. That is that you would describe it as saying that the market is not very volatile or is very volatile. So that you should, what you're referring to is market volatility, or you can say talk about trading ranges. Okay, sometimes you have very tight trading ranges. Like I showed you guys the chart of, if you see the classical chart of crude oil that I showed you guys, the West Texas crude oil chart. If we look at the monthly, okay, so it's only like this. Let's look at weekly. And why is it like that? I thought we had. Right. So if you look at this crude oil price movement in this period, okay, from 1985, before that also, all the way up to here, you can see that the trading ranges, you understand what is a trading range? Is the amount of, the high and the low, essentially, defined by the high and the low, the trading range. So at this point of time, when we are describing this period in the history of the oil market, we are going to say that the trading ranges were very narrow. Okay, or the market, another thing we could say is that market volatility was quite low. Okay, because it was not moving around much. Okay, so that is what we would say. So it is not, bearish and bullish are not appropriate to describe this kind of aspect of market activity. And here we would say that suddenly volatility has picked up in this kind. When we are looking at this phase of the market, we would say that suddenly that volatility has picked up and trading ranges are much wider. Okay, can you see that? Okay, so this is real activity in the oil market. You can see how dramatically prices change, and the nature of price action also changes. Okay, so it's not just that the price is changing, the nature of the movement is also changing. Okay, so that was your original question. You had an earlier question also before we started.
Sir, I didn't understand the concept of.
Didn't understand.
Didn't understand the concept of earning call.
Earnings call.
Yes.
So the earnings call is essentially a conference call. Okay, you understand conference call?
Yes, sir.
Okay, so earnings call is just a conference call. It's like instead of saying earnings conference call, we call it an earnings call. Okay, so it's an earnings conference call where the top management of the company will, you'll find, I think if you search on Yahoo Finance, you may find the earnings call link also to the audio. Okay, so you won't get invited to the earnings call because only the analysts are invited typically. Okay, so that's a conference call between the analysts who are covering the company and the top management of the company. So the CFO, the CEO, the chairman maybe, okay, some of the top management team, okay, and the analysts who are covering the company. So the analysts will ask the CFO, the CEO, they'll ask them lots of questions, like what is your expectation for future quarters, what is happening, are you seeing any effects from the trade war, are you seeing any effects on your orders, you know, this kind of stuff. So it's just a conference call. It's a conference call. The subject matter of the conference call is the recent earnings release, okay, which is basically they'll do it probably one day or the same day, one day later or the same day as the earnings release, and they'll get together with the analysts. And I think if you go to the company website, you'll get the earnings call there. If you go to the investor relations page, you'll get the earnings call transcript there as well. Okay, so that's what it is. Okay, it's just a conference call. Okay. All right. Yeah.
So in the last video,
Mike.
Yeah. In the last video, you mentioned about tight stops or tight stop.
No, I said tight stop.
Tight stop.
Tight stop as in tight and loose. Okay, like this shirt is very tight or this shirt is very loose, in that same sense. Okay, sure. Tight stop means essentially tight stop. You understood the term?
No.
You understand stop?
Yes.
Okay, and tight and loose you understand?
Yes.
Okay, so tight stop is essentially this. Like if I gave you this example, like I gave you this example of dollar yen, right? If I look at this. Now, if I have a bearish view on dollar yen, okay, if I have a bearish view on dollar yen, I will obviously go short, okay. Now, as far as the placement of the stop is concerned, on this chart, you can see at least two or three clear options, okay, for placing the stop. Multiple clear options. I have many options. So if we'll see the logic for this a little bit later. As you notice, these are going down in waves, okay, and the previous highs and lows are not being broken, right, in a particular clear trend. Okay, that's actually the definition of a trend, which we'll get into later. So I use this simple logic. So I could place my stop at, so if I'm going short, okay, so if I'm going short, the stop will be above the market. I'm assuming always that I'm going short at the market or going long at the market. Is everyone clear about the terms that I'm using so far?
Yes.
Okay, going short at the market price. Okay, now I have to place a stop, and I should always place a stop. Okay, so I have multiple options. I could place it here, and usually I would place the stop at a previous high or previous low, which you can see on the chart. Is this clear?
Yes.
Okay, Mayank, you're not looking convinced. Are you convinced? So you're not able to follow?
No, I have another doubt, but
Okay. So now this, does everyone follow that this is one option? If I'm always placing the stops at previous highs and lows, okay, the logic essentially is that when I look at a trend, I see that when there's a trend happening, it's not breaking the previous highs and lows. Okay, it just goes in lower highs, lower lows in a downtrend. That's actually the definition of a trend. Okay, higher highs. I don't want to get into that right now because it's a little bit technical. But generally, you can one safe way to, I can just tell it to you without giving you the logic. Okay, I'm just telling you that generally when you're trading from a technical perspective, okay, you should place your stops at previous highs and lows. Okay, so obviously if I'm going short, my stop has to be above the market, because what will happen when the market hits the stop trigger? I will have to buy back my position. I went short dollar, means I sold dollars. Maybe it's a little easier. Let me not confuse it with currency trading because it's a little more complicated. Let's go back to, let's say, let's look at a chart which is actually bearish. Yeah. Now you see Tesla Motors here. Okay. Now suppose I am okay, so let's just use this one. Okay, now suppose I'm bearish on Tesla. Okay, so you notice how this trend is going. If you see, this is like the definition of a downtrend, a sequence of lower highs. All the highs are lower. Can you see that?
Yes.
All the successive highs are lower. Okay, this one is a little bit, but if you don't count these smaller waves, okay, you have to focus on a particular degree of movement. Don't try to look at all the waves of different degree together, then you'll get confused. You lock into a degree of movement. That means at this point I'm only looking at this size of movement, this up, down, up, down, up, down, up, down. Okay, so I see that it's all the highs are lower. In the downtrend, I see that all the highs are lower, all the successive lows are also lower. Okay, if you just look at a chart later on, you don't have to remember this. Like, don't try to say higher highs, higher low. It'll be like Betty bought a bit of that kind of thing. Don't confuse yourself. Just look at a chart and then recall the definition by looking at the chart. Okay, because this is all actual data. Okay, in every chart you'll see, on every chart you're going to see this pattern everywhere. So here I can see that all the highs are lower, all the successive lows are also lower. Can I see that? Low 1, low 2, low 3, low 4, low 5. Can I see that all the lows are lower, all the highs are lower? So if I feel that, so here we're getting to the logic of that, okay, maybe we should just do it at this stage, but it'll slow us down further. But once again, you understand the logic of purely technical trading and see how simple it is. So the reason I'm doing this, we are covering, spending a fair bit of time on purely technical trading approaches, is because it's a completely legitimate approach, okay, although it's not the mainstream approach. And second is that it's very simple. Okay, once you start getting into that business, once you start thinking like a surfer, then I don't need to worry about what is the battery, how low can the battery costs go in Tesla, how many cars are they going to sell, what will be the future of autopilot, self-driven cars and all that. That's all fundamental analysis. Okay, as you start going into that kind of, what will be the adoption of electric vehicles, what will be the competition from BMW and all these other car makers who are also getting into this EV business. Okay, so all that is, if you start going into those things, that's fundamental analysis. Okay, but if you're a technical analyst, if you're a technical trader, you don't care about anything, you just care about the price and maybe volume and some other market related stuff. Okay, no interest in, actually, for all practical purposes, I need not even know that this company makes cars. Okay, I don't really care about what this company does as a technical trader. It's important to understand that perspective. As a technical trader, you're just concerned with the price, some price based calculations, all based on price and volume. Price, volume and open interest, which we won't get into open interest right now, but essentially market generated information, market activity generated information. Price is generated by market activity. People are buying and selling, that's how you know that that's the price, right? So it's a very unique kind of perspective, and it's useful to be able to understand this perspective also, even if eventually later on you decide I'm only going to use fundamentals, but still you should know what technical trading is. Okay, and it's a completely, as I said, if you feel comfortable with this approach, totally go with it. Don't worry that you're not looking, am I doing something wrong, like I'm not looking at the fundamental. No, there's a totally legitimate approach as long as you stick to highly liquid stocks and highly liquid assets. Okay, in generally everywhere in the world you have to stick to highly liquid markets, which means highly liquid means very high levels of activity, high volume traded. Okay, that's liquid. So if you're applying this purely technical trading strategy in India, in Indian equities, the rule would be don't go beyond the Nifty 50 stocks. Don't start trading all these Banana Republic small stocks. Okay, that should be out of bounds. You should trade, if you're a purely technical trader, you should only trade Nifty 50 stocks because they're all very liquid. Is the message clear to everyone?
Yes, sir.
Okay, so what we are discussing now is all these elements of technical trading. So you understand how, you'll see how logical the system is and how simple it is. Okay, so that's one of the reasons I'm giving it to you, so that you can use this in your trading. At least as a starting point, you'll have something, because fundamental analysis is a massive domain actually. It will take a long time to cover everything that's involved. Okay, and it's also not easy to come up with simple trading rules. Okay, so here you can see, so the definition of a trend essentially is, so we are defining a trend. So where should we put it? Let's put it in the NSE. Okay, so uptrend equals series of, we have all this stuff written down somewhere. I've just got to find, because right now what is okay, so we'll see the swelling later. Higher highs both highs and lows are higher. Okay, if you look at an uptrend. Okay, like this part is an uptrend here. The lows are higher and the highs are also higher. This is clear? Simple. Don't have to memorize this definition. Just draw the pattern on a sheet of paper, that you know what kind of pattern to draw. That it's always going up and it's always going down. Okay, in this sawtooth pattern. And then this actually here you can see from here itself. Actually, it started from here. So this high is actually, you can't make out here, but this high is actually lower than this high. So this really was the high in Tesla, which means Tesla has not gone made a new high since June of 2017. Okay, so this I figured out by looking at you have to closely look at Yahoo Finance or somewhere. Go, and even here you can do it. You can change the thing, and then you can really zoom in and read the values. Read the value. You can see the values are coming up here. Can you see them? When you move your cursor, the values are coming up. But since this is an hourly chart, a 4-hourly chart, it'll be difficult to read the exact high. But this high is actually lower than this high. So on a larger pattern, you can also say high 1, low 1, high 2. Low 2 has not yet gone below low 1, but now it has gone below low 1. Okay, so if you count really big moves like this. Anyway, so now you can see also on the downtrend, you can see series of successively lower highs and successively lower lows. Is this clear? Is everyone following?
Yes, sir.
Simple definition of uptrend and downtrend. Okay, so and you can apply this and test it on any chart. Everywhere you look, you'll see all these uptrends and downtrends. Okay, so essentially what we are saying, higher highs and lows. So we are getting into some of the actually we are not, I was not able to cover what I intended to cover, but anyway, it doesn't matter. We've got into this naturally, that's fine. Downtrend should be what? Should be lower highs and lower lows. So it's clear in the case of a downtrend. Very simple, no need to memorize. Okay, where does this need to revise? Okay, this need to revise can be removed. Okay, so okay, so successively lower highs and lows, as you can see here, Tesla. Okay, so for instance, so what was I discussing? Tight stop. We were discussing the concept of the tight stop. So we should actually have this as also something, tight stop. Well, let's put loss here. That stop trigger is close to the entry price, and opposite of tight in this context is not loose, it's actually wide. Okay, wide stop trigger is far from, let's say quite far from the entry price. Okay, let me give you an example of what this means. So we got into the definition of these are connected ideas. Okay, so essentially, see, again, we can, instead of looking at, we decided not to look at currency markets because they become a little confusing. Okay, so everyone knows that if you're trading Tesla, you're buying and selling Tesla shares. Okay, so if I'm bearish on Tesla and we make the simplifying assumption that I always enter at the market price. Whatever is the current market price, I enter at that price. So in that case, so I go short at 223. Now see, let's first understand why the logic. What is the logic of putting the stop? What is the logic of putting the stop at the previous high and the low? Okay, now if my view is bearish, then what is my projection? That means if you ask me to draw a projection on a screen with dotted on a page with dotted lines, my dotted lines would go like, essentially, why am I bearish? Another way of stating the bearish view is to say that my view is that the current downtrend is going to continue. The current downtrend is going to continue. Okay, which is another way you can say that the current downtrend is incomplete. Okay, the current downtrend is going to continue. It's incomplete, which therefore obviously it has to continue. So if the current downtrend is going to continue, what should you see as you project? What is the downtrend? Successively lower highs and lower lows, right? So as the downtrend continues, it should continue to make lower highs and lower lows. That is the characteristic of a downtrend. Is this clear? And what that means essentially is that whatever, as it is rising from here, it can't make a high higher than this, because then that would not be a lower high. Is this clear? Okay, and it has to make a low lower than this, because only then do you get a lower low. Is this clear?
Yes, sir.
Okay, everyone is following? Surabhi, you're following? Okay, what is the logic? And so what is the meaning of having a bearish view? Is having a bear? Yeah.
Can you please explain this?
Yeah, so we are trying to understand what does it actually mean to have a bearish view? Okay, so what does it actually mean to have a bearish view? So here, what it means is essentially that if I have a bearish view, that means I'm saying that the downtrend is still going, it's still continuing, which is another way of saying that is that the downtrend is incomplete. Okay, so incomplete means it has to keep on, it has to go in the same direction and complete. Okay, so it is still continuing. Okay, it is still in progress, it is still continuing, whatever you want to say. So the downtrend is still in progress. Okay, still going on. So if the downtrend is still continuing, then what is the characteristic of a downtrend? Lower highs and lows, lower highs and lower lows. Okay, so in that case, if the characteristic of a downtrend is lower highs and lower lows, and by having a bearish view, okay, now we are not getting into the question of how did I come to my bearish view? Why is my view bearish and not bullish? That's a very big question. We are not getting into that right now. Let's assume that somehow even by tossing a coin, I came to a bearish view. Okay, so you take that as a given. But what does it mean once you say that I have a bearish view? Okay, once I say that what that means essentially is that I am saying that the downtrend is not complete, it is still continuing. So therefore, and since the characteristic of a downtrend is lower highs and lower lows, then we should continue to see lower highs and lower lows. This is logical. Okay, now it sounds like a lot of English words, so it might get a little confusing, but you understand this concept so far?
Yes, sir.
Okay, yes, Bharat, anything? Okay, all right, so therefore is it clear now, Yash?
Yes, sir.
So as a first step, so go step by step. So it's good that you asked a question. Whenever anything is not clear, any step is not clear, immediately ask a question. Okay, so at least we make sure that whatever we cover, okay, even if it's 5 centimeters, whatever we cover, everybody is 100% clear about that. Okay, all right, so the first thing we have done is established what is the meaning of a bearish view. A bearish view means you're stating that in your opinion the downtrend is still incomplete, it is still continuing. And then we call back the definition of a downtrend, a series of successively lower highs and lower lows. So therefore, if the downtrend is still continuing, then we should continue to see lower highs and lower lows. This is clear?
Yes.
Very logical? Okay. Now, if that is the case, then we can't have a high higher than this.
Yes, sir.
If my view is right, we can't have a high higher than this, and we should have a low lower than this.
Yes.
Right? If my view is correct, right? Okay, so that is the logic now. Therefore, if I'm going short Tesla, and we assumed, as I said, that if you have a bearish view, you will go short, and you will always go short at the market price. You will go short or long, or whatever trade you do, you'll do at the current market price. Okay, so I go short at 225, let's say, or 223. Okay, and now where is my stop? Now think about this. What does the stop actually do for you? Okay, a stop is a signal to you, a stop here, the trigger level for the stop, and then once the trigger is hit, then it'll execute a market order and take you out of the position. So first understand what a stop does. The stop reverses your entry position. Okay, so we can write this down as well here. Okay, so I'm only writing one side of the equation. Bearish view, then you can flip it around for the other side. Okay, view implies that current downtrend is still in progress. Is that okay? It's still in progress. Okay, implies we should continue to see Is this clear? The logical flow is clear?
Yes.
So far? Okay. We should continue to see successively lower highs and lows. Okay. And this condition should not obviously be violated. Okay. So now, where were we actually? Yeah, so I was saying that we assume that we always trade at the market. Now, what is the stop actually? Why do you place, the place where you put the stop, which is essentially what the stop does for you. Let's write this down here. A stop, we can call this a stop loss initially. Right? A stop is meant to reverse the original position entered into and 0 position. Okay, remember we talked about 0 position. I think it was Gulati who had asked about what is the position, and yes,
We have not talked about zero position.
when we discussed intraday trading. Intraday trading, remember we discussed intraday. What is the definition of intraday trading? That at the end of the day you have 0 position. And then we discussed, then Gulati asked about what is the position. Then we discussed a position. Position is if your balance sheet is all cash, your asset side of the balance sheet is all cash. So I've given that long definition in your notes. Okay, so one of the things you guys are going to find is that whatever we are learning, the notes are a little bit scattered here and there. Okay, partly because it's a little counterintuitive because I'm trying to make it organized, but the notes may be a little scattered here and there, but that should be, you should just deal with it. Okay, somebody was saying once that I want all my notes in one place. We can't have so much spoon feeding. Okay, so to save time, we are doing some of this. Your notes are, but you know where the notes are. You have access to the notes, and you don't really need to take much notes, too many notes in class, because everything that's important I'm writing down. Okay, so if you see 0 position, so what is the objective? Understand what is the objective of the stop order or the stop loss order. The objective is essentially to take you out of your position completely. You understand what I mean by this? That, for instance, if I sold, let's say, 5,000 shares of Tesla, okay, when I put a stop order, the objective of that stop order is that once that stop order is triggered and executed, okay, once that order is executed, okay, then it should, now I've sold 5,000 shares of Tesla. After the execution of the stop order, this is my entry trade. Okay, I went short 5,000 shares of Tesla. Now once the stop is hit, once the stop is triggered and the stop order is executed, it will essentially it should create a position where I have left with 0 position. So initially my balance sheet, if you look at the trader's balance sheet, initial position, let's say, is all cash. Okay, so the asset side is all 100% cash and the liabilities is 100% owner's equity. Okay, now what happens is you buy 5,000 shares of Tesla. Okay, so whatever it costs you, that cash balance goes down by that much, and then the asset mix has changed. Now instead of just having all cash on the asset side, you have 5,000 shares of Tesla plus the remaining cash. Is this clear? And the owner's equity will remain unchanged initially, but as the price of Tesla fluctuates, that owner's equity will keep changing. Okay, if the price goes up after you bought it, the owner's equity will increase. If the price goes down after you bought it, then the owner's equity will decrease. Is everyone following so far?
Yes.
Okay, everyone clear? Okay. So therefore, once you execute the stop, once you execute the stop for the full position, the result of the execution of the stop order is that you go back, you have no position left. So once again your balance sheet returns to all cash. Okay, balance sheet returns to all cash, and then again liabilities is owner's equity. Okay, but in this case, because you have a loss, so your cash balance was lower and your owner's equity has gone down essentially because you have a loss. Is this clear? Okay, so if you lose $10,000, let's say you started with $100,000 and you lose $10,000 on this Tesla trade, okay, then after the execution of your stop order, your balance sheet has gone back to all cash, but now the balance sheet size is $90,000. Okay, you started with $100,000, you lost $10,000, so your balance sheet size has shrunk now. You have 90,000 of cash and 90,000 of owner's equity, and 10,000 of owner's equity has gone up in smoke because you lost that money. Okay, this is the same concept of statement of changes in shareholders' equity. Now if you drew the same analysis here, you will see that there is a statement of changes, and because your P&L is showing a loss of $10,000. Clear? Is everyone following?
Yes, sir.
Burma, you're following? Okay, your nod is not very convincing. Is it a convincing nod?
Yes.
Okay, your yes is also not very convincing. Okay, all right, okay. So, all right. So, is this clear?
Yes.
The objective and the result, the consequence of the triggering of the stop order, the execution of the stop order. So, understand it in technical terms. What is not a position? Cash is not a position. If you see in the detailed notes I've given you in your summary sheet, in the summary document where we keep track of what we are covering every day, that summary document, there I've defined the position. Okay, read it, you'll see. So, their position means cash is not a position. Because position is only something which is an exposure which can cause us to lose money. Cash does not lose value. If we ignore inflation, cash does not lose value. Okay, so all cash is not a position. The moment you go from all cash to some cash and 5,000 shares of Tesla, now you've got a position. Because the shares of Tesla, the share price keeps fluctuating. So that's the meaning of a position. Okay, so essentially once you execute the stop order, you have gone back to a zero position. Your balance sheet is once again all cash. You have realized a profit or loss. In this case, stop loss is you realize a loss. Okay, because it's straight away after doing your trade. Is this clear so far?
Yes.
So the objective of the stop is to take you out of your position. This is what we call being taken out of the position. Your position is completely removed. Whatever you started with, it's removed completely. Is this clear? Okay. Now, so think about it logically. I went short because I had a bearish view. So obviously now it's understood here that everybody wants to make money. So if I have a bearish view, I'm not going to go long, because then if my view is correct, I'll lose money. But so obviously everybody wants to make money. So you assume that, and if I have a bearish view, that means my mental projection is no high above this and a new low above this, below this, new low below this, continuing pattern of lower lows and lower highs. This is my projection. So the way you profit from that, if that's going to be the market projection, the path of the market price, how do I profit from that? By going long or by going short? By selling it, not by buying it. Okay, so that's why I go short. So you see, everything is logical. You can actually program it into a computer. Once you put in the initial assumptions, everything follows logically. Okay, you don't have to memorize anything. Why are you going short with a bearish view? Because a bearish view implies a projection of continued falls in the market price. And since everybody wants to make money, how do you make money if the scenario is going to be continued drops in the market price? The way you make money is not by buying that share, but by selling that share. So that's why you sell that share and go short. This is clear? Everyone follows?
Yes.
Okay, so this is why a bearish view is consistent with a short position, and a bullish view will be consistent with a long position. Okay, so far everything is logical. Okay, so now I went short because I had this bearish view. Okay, and the bearish view is equivalent to saying that the downtrend is still continuing. Okay, but what happens? What kind of statement? What kind of information is the market giving to me if after I go short here, the market goes and shoots above this 257 high? Then what kind of information has the market given me? Is my assumption about the continuation of the downtrend, is this still valid?
No.
It's no longer valid. Okay, so if you do something based on a certain assumption, okay, I did my short trade based on the assumption that the downtrend is still continuing. Now if I did something based on a certain assumption, once I have information that the assumption is no longer valid, then should I continue to do that thing?
No.
I should unwind it if possible. Okay, which is essentially what, remember I gave you the story of I think it was Royal Dutch Shell and that 7 billion investment in the Alaskan drilling project, right? So what was the assumption that they made? $100 barrel, $100 oil. Okay, so the average price realization, they were expecting $100 oil when they did the NPV analysis of the project. That's why they went into the project. Okay, so after a few years they found that they changed their view and they felt that the assumption of $100 oil is no longer valid. So once the assumption is invalidated, assumption based on which they entered the project, the key assumption, so they did the rational thing, which is that they took out, they exited from the project. They did not make any further investments. This is clear?
Yes,
so this is consistent. So once you do something based on a certain assumption, and then you find that the assumption was not actually valid, then logically you should unwind that action if you can. Sometimes you can't. Okay, but if you can, you should. Is this clear to everyone? Logical? Okay, so therefore now you understand better why I say that one of my options is to place the stop here. try to sort of add up all the things that we have covered. What is the goal of the stop? The goal of the stop is to reduce my position to 0. Okay? The goal of the stop is to reduce my position to 0, which means I have no commitments in the market. Okay? And if my assumption is I do a trade, I go short Tesla shares based on the assumption that the downtrend in Tesla is still continuing. But when the market shoots above this 257 high, let's say goes to 273, next price I should go short at 223, next price is 273. Okay? Then the market has invalidated my assumption that the downtrend in Tesla is still continuing. So whatever I did based on that assumption, that I should undo it if I can. Okay? So therefore I should, and how do I undo it? I execute a stop order, because we know that what does the stop order do? It basically cancels your position effectively. It does the reverse transaction. If you sold 5,000 shares, when you put the stop order will basically do a buy of 5,000 shares, so that it will have the net effect of leaving you with a 0 position. Are you following so far?
Yes, sir.
Everyone is clear?
Yes, sir.
Okay, all the steps are clear logically. Go back and replay the video and make sure you understand. So all the stuff that we covered, pretty much the last 2 sessions, everything I've been talking pretty much continuously, and all the time we are covering important concepts. You have to go back, make your own notes, listen to the video, make your own notes. That's how you learn. Okay, so I don't make you take notes in the class, because that way we can make the most use of the class time, so that you can be attentive in the class. But later on, to internalize the learning, you should try to make your own notes. If you feel you need to, it will benefit you, right? But at least you should go through. I see only 8 views or 9 views. Okay, so I should see lots more views, because everybody should be revising all the concepts, because I'm pretty sure you haven't understood it on the first hearing. Okay, so you should replay the video and take notes. Okay, whatever you feel you need to understand, then you can play it back again, etc. Okay, so now is everyone clear? But you've learned something useful today. You learned how technical trade. You see that everything is totally logical. Everything is don't fold your books yet. We are not done yet. Okay, we have 3 minutes, 1 minute. So everything is so far you follow. I have a bearish view, implies certain thing about the continuation of the trend. I go short because I want to profit from the continuation of the trend. The moment the market violates the condition of lower highs and lower lows, that means it's destroyed the uptrend or neutralized the downtrend. Okay, so if I went short based on the assumption about a continuation of the downtrend, when the assumption is invalidated, I should exit my position, exit whatever I did based on that assumption, which means I should exit my position. So that's why I should do a stop loss. Okay, and this is the reason why the stop is placed here, because this is the earliest point at which the market is giving me information that my assumption was wrong. Okay, but as I said here, now we are coming back to Khushbu's question about tight stop and wide stop. What does that mean? Now if you see here, there are many ways to do this. Okay, I could say that I'm looking at this degree of trend, down, up, down, up, down, this degree of trend. Okay, in which case I would place my stop here, because I can see this is clearly the most recent high from which a new low was made. Okay, alternatively, I could say, and this would be an example of a tight stop based on the data we have here. Okay, it's reasonably close to the market. Now, why you see why this is a tight stop when I show you what is a wide stop. Now, what is a wide stop? I could say that no, this stuff is too small. This movement and all is too small for me. I look at these big movements: 1 down, 2 up, 1 down, again down. So I would place my stop over here, 379. Because all this stuff is too small for me. I don't really care about these small movements. So my stop is at 379, okay, or 380, 379, whatever, 380. So that is also a logical statement. It just depends on what degree of movement are you looking at. Okay, here I was looking at fairly small degrees of movement. You understand what is meant by degrees of movement?
Yes,
I've just shown you that here you can look at different degrees of movement. I could just say all this stuff is too small for me. I don't care about this. I just care about these big moves, down, up, down, up, down. So here, therefore, I put my stop over here. Now this becomes a wide stop. And so the definition of tight stop and wide stop, as you can see here, is, I think it's on the other page, okay, its stop trigger is close to the entry price in the tight stop. Okay, 1 more minute left, 1 minute. In the case, this is a tight stop, 259 is a 258 is a tight stop because it is closer to the entry price. Entry price is same in both cases. Entry price is at the current market. There is only one current market price. So entry price is 223 in both cases. The tight stop is 259, okay, and the wide stop is 379. So you can't really understand a tight stop unless you also have a reference of a wide stop. Okay, so ideally you would have both references, but now you understand what is meant by tight stop and a wide stop. And we already had a discussion about expected value, remember? Wide stop means lower chance of getting triggered, but higher loss if you have a trigger, if it's triggered. Go back and listen to the videos, connect all this stuff. And tight stop means higher chance of getting triggered, higher probability, but average outcome is lower, average negative outcome is lower. Everybody's looking black. We had this discussion the other day. Remember? So you should connect to a related idea, mathematical expectation. So revise all this stuff. Listen to the videos, revise all that stuff, right? Okay, now you can go. Your question is a technical question, and I'll keep the recording open.
No, the thing is, you are trying to explain that a tight stop basically means that when we see the smaller variations near to the entry price, and a wide stop means that when we see larger variations and then the larger stop.
Yeah, it is totally about the zoom. Like in cameras, you have a zoom concept.
Yes.
I can look at these people here. Then I can just zoom in and look at Rajan.
Particularly, and then
So that's zoom. So what level of zoom?
will be tight.
What zoom are you using? If you have zoomed in a lot, then you have a tight stop.
And
If you have zoomed out, then you have a wide stop. So therefore, when you're looking at charts, you have to be very clear about what is the zoom that you're using. Don't use multiple zooms together, then you'll get confused. Okay? Clear? Tarun, you have a technical question? Okay.